This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, August 26, 2026, and this is the After Hours session. Now, let's get into it. The Nasdaq is leading the charge, pushing higher while the S&P 500 holds steady near its 5-day highs. But look closer at the rotation. Energy is getting hammered, down nearly 2%, and software stocks are taking a hit with Intuit gapping down over 11% in after-hours trading. Meanwhile, retail is showing surprising resilience with Abercrombie and Fitch surging nearly 14% on strong coffee and guidance news. We have GDP and durable goods data due tomorrow, and the market is pricing in a mixed macro signal. Let's see what the data actually says. On the economic calendar, the big focus is tomorrow, Wednesday, August 26th. We get two major macro releases, durable goods orders and the second estimate for gross domestic product. The GDP print is crucial because it will show if the economy is maintaining the 1.48% annualized growth we saw in the second quarter, or if momentum is stalling. Durable goods will give us a read on manufacturing demand heading into the late summer.
The market is currently in a low volatility risk-on regime, so these prints will likely get digested quietly unless GDP surprises significantly to the downside.
Let's look at the numbers. The S&P 500, tracked by SPY, is up 0.32% to $765.91. The Nasdaq, tracked by QQQ, is the clear leader, up 0.62% to $710.72. The Dow Diamonds is up 0.30% to $535.24. The Russell IWM is also higher, up 0.42% to $299.23. The headlines driving the tape right now are centered around earnings anticipation and sector-specific catalysts. NVIDIA is facing earnings expectations, and the news sentiment is overwhelmingly bullish, with 72 articles pushing sentiment positive. That is clearly fueling the Nasdaq's outperformance today. The sentiment data confirms the tech dominance. We are seeing a broad risk-on flow into technology, with the fear and greed index sitting at 55, suggesting the crowd is comfortable but not euphoric yet. In the energy complex, the sector is under pressure, down more than 1.5% today.
I want to flag the risk there. The energy sector is seeing a massive rotation out of it, and with crude oil commercials at the 100th percentile, the positioning is extremely crowded on the long side. That makes the current downside move feel like a profit-taking event that could accelerate if demand data comes in weak tomorrow.
In retail, Abercrombie and Fitch is surging nearly 14% on strong performance and upgraded guidance.
This is a classic earnings catalyst play. The stock is gapping up on positive fundamental guidance, showing that consumer discretionary spending is still supported in specific subsectors, which contrasts with the software weakness we see elsewhere.
Let's start with our top priority, the Nasdaq, tracked by QQQ. It's up 0.62% to $710.72. Grid, what does the technical structure look like right now?
The chart is holding its ground nicely. QQQ is trading above its recent range, testing the upper boundary of the last 5-day consolidation. We saw a low of $702.70 on Monday, August 24th, and since then the price action has been higher highs. The key technical level to watch is the high from Monday, which was $714.04. As long as QQQ holds above the 71.0 level, the intraday trend is bullish.
The flows support this. We are seeing strong institutional positioning in the S&P 500 E-mini futures, with commercials at the 100th percentile, which is historically a bullish signal for equity futures. Additionally, NVIDIA's earnings beat of 121% year-over-year provides a fundamental anchor for this technical strength. The market is pricing in continued growth from the AI infrastructure build-out.
I'll add to that on the sentiment side. The put-call ratio for QQQ is at 1.29, which is high, but the implied volatility rank is at 99, meaning options are expensive. Usually, when Roman 4 is that high and the price is rising, it suggests that buyers are willing to pay a premium for upside calls, indicating strong conviction in the tech rally. So we have technical support at 71.0, bullish positioning, and strong earnings momentum. Apex, how do you synthesize this?
The alignment is clear here. Grid technical hold at 71.0, combined with CIPHER flow data showing commercial positioning at the 100th percentile, creates a favorable setup for the Nasdaq. Pulse observation on the high Roman 4 suggests that while the market is pricing in risk, the direction of the flow is firmly upward.
Let's pivot to the laggard, the energy sector, tracked by the energy sector. It's down 1.66% to $62.06.
Technically, the energy sector is breaking down. It's down nearly 3% on the week, and the price action is testing the lower bounds of its recent range. The low from Tuesday, August 25th, was $62, and today's move is pushing against that support. If it breaks below that, we could see a retest of the $60 level.
And that's exactly what I'm worried about. The energy sector is seeing a massive rotation out, and the positioning data shows commercials at the 100th percentile. That is extremely crowded. When everyone is long, even a minor negative catalyst can trigger a cascade of exits. The put-call ratio for the energy sector is at 1.81, which is very high, indicating that traders are actively hedging against further downside. This isn't just a normal pullback. The risk management flows are kicking in.
The sentiment is shifting. While the broader market is in a risk-on mode, the energy sector is seeing negative flows. The sector rotation data shows energy as one of the biggest laggards over the last week, down 2.54%. The crowd is rotating out of energy and into technology and communication services. So we have a technical breakdown, crowded positioning, and negative sentiment. Apex.
The data points to a defensive posture here. Grid technical warning at $60, combined with SPECTER risk flag on the crowded commercial positioning, suggests that the energy sector is vulnerable to further downside. Pulse sector rotation data confirms that capital is moving away from energy, so the path of least resistance appears to be lower until the positioning can normalize.
Next, let's look at INTU, tracked by INTU. It's gapping down over 11% in after hours, trading to $317.76.
On the chart, this is a violent break. An 11% drop is a massive move, and it's likely breaking through all short-term moving averages. The support levels are now undefined because this kind of gap creates a new baseline. The price action suggests a fundamental shock rather than a technical correction.
The catalyst is earnings anticipation. The headline mentions NVIDIA earnings and a software sector decline. INTU is a key software proxy, and if the broader software sector is under pressure, INTU is likely catching bid. The fundamental data shows that software valuations are being re-rated, and without a specific positive catalyst for INTU, the market is selling the name aggressively.
I want to stress test this. An 11% drop in after hours is significant, but we need to look at the volatility environment. The VIX closed at 15.85 yesterday, which is low, but the implied volatility for software stocks is likely spiking. If this drop is driven by sector-wide weakness rather than company-specific issues, the selling could extend. The risk here is that the market is using INTU as a proxy for broader tech valuation concerns.
So we have a fundamental shock, technical breakdown, and sector-wide weakness. Apex.
This is a clear risk-off event for the software sector. Grid technical break, combined with CIPHER identification of the earnings-driven catalyst, suggests that INTU is in a price discovery mode to the downside. SPECTER point about sector-wide weakness is critical. If the software sector is declining, INTU's drop might not be isolated. The strategy here is to stand aside until the volatility settles.
Let's move to Abercrombie & Fitch, tracked by ANF. It's gapping up nearly 14% in pre-market to $123.90.
Technically, a 13.8% gap is a breakout. The price is now trading significantly above the recent range, which was around $108. This is a momentum move and the volume will be key to sustaining it. If the stock holds above $120, the technical structure is strongly bullish.
The catalyst is strong performance and upgraded guidance. The headline highlights Abercrombie and Fitch navigating retail demand positively. This is a fundamental improvement in the company's outlook, which is driving the institutional buying. The earnings estimate for ANF is $1.48, and the guidance upgrade suggests the company expects to beat that.
The sentiment on retail is positive. The sector data shows consumer discretionary is down only 0.30% today, so retail is holding up relative to other sectors. The fear and greed index is at 55, which is neutral, but the specific sentiment for ANF is bullish, driven by the earnings guidance. So we have a technical breakout, fundamental catalyst, and positive sector sentiment. Apex.
This is a classic fundamental-driven momentum play. Grid technical breakout combined with CIPHER earnings guidance upgrade creates a strong setup for ANF. Pulse sector data confirms that retail is resilient, so the name is likely to hold its gains. The strategy here is to follow the momentum, provided the volume supports the move.
Finally, let's look at the S&P 500, tracked by SPY. It's up 0.32% to $765.91.
The SPY chart is consolidating near its 5-day high. The high from Monday, August 25th was $766.78, and today's price is right at that level. The support is at the low from yesterday, which was $763.05. As long as SPY holds above that, the trend is flat to slightly bullish.
The breadth data is positive. We have a Zweig breadth thrust detected, with 1,320 advances versus 679 declines. This is a historically bullish signal. The COT data shows commercials at the 100th percentile, which supports the idea that institutional money is aligned with the index.
I want to flag the yield curve risk. The 2-year, 10-year yield curve is at plus 0.47 percentage points, which is flat. A flat yield curve is often a precursor to economic slowdown, and we have GDP data coming out tomorrow. If the GDP print is weak, the current consolidation in SPY could turn into a sell-off. The VIX was at 15.85 yesterday, which is low, but that can change quickly if macro data disappoints.
So we have technical consolidation, positive breadth, and a macro risk flag. Apex.
The S&P 500 is at a crossroads. Grid technical consolidation at the 5-day high, combined with CIPHER positive breadth data, suggests that the market is strong. However, SPECTER point about the flat yield curve and upcoming GDP data is a valid risk. The strategy is to stay long but be prepared for volatility if the macro data comes in weak.
To summarize today's analysis, the Nasdaq is leading the market with strong technicals and bullish positioning, while the energy sector is under pressure due to crowded longs and negative sentiment. Intuit is facing a sharp drop on earnings anticipation, and Abercrombie and Fitch is surging on fundamental guidance. The S&P 500 is consolidating near its highs, but the flat yield curve and upcoming GDP data present a macro risk. Tomorrow, watch the GDP print on Wednesday, August 26th, to see if the economy is maintaining momentum.
The Nasdaq is holding above its key support levels and testing resistance. The technical structure is intact and the price action is bullish. My weekly call, QQQ bullish, targets $720 by Friday.
The energy sector is seeing a massive rotation out, and the positioning is extremely crowded. The technical breakdown is underway, and the risk of further downside is high. My weekly call, the energy sector bearish, targets $60 by Friday.
The S&P 500 is showing positive breadth and institutional support. The earnings data is strong, and the positioning is aligned with the index. My weekly call, SPY bullish, targets $770 by Friday.
The sentiment is neutral, but the risk-on regime is intact. The rotation into technology and retail is positive, and the fear and greed index is stable. My weekly call, QQQ bullish, target $715 by Friday.
The market is in a low volatility risk-on regime, but the macro data presents a risk. The alignment of technicals, flows, and breadth supports a bullish stance on the index, but the energy sector is vulnerable. My weekly call, SPY neutral, target $765 by Friday.
If you're finding value in this analysis, support the project at patreon.com/ShadowQuant. Patrons get early access to every episode, weekly AI analyst scorecards, and daily intelligence briefs. And if you're listening on Spotify, Apple Podcasts, or YouTube, hit that follow button and leave a rating. It helps more traders discover the show. We appreciate you. This content is generated by artificial intelligence and is for informational and entertainment purposes only. It does not constitute financial advice. Equity markets involve risk, and past performance does not guarantee future results. Always do your own research before making any investment decisions. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.